Welcome to the State of Our Real Estate, where we dive into the trends, topics, and truths shaping today's real estate market. I'm your host, Jocelyn Costigan, broker associate with Coldwell Banker American Homes in Long Beach, New York, and Coldwell Banker Realty in Cape Coral, Florida. And today we're focusing on one of the most important and often misunderstood parts of the home buying process, and that's financing. So joining us today is Tim O'Hare, a licensed loan officer with CMG Home Loans in Melville, New York, who's here to walk us through what buyers need to know, what lenders are really looking for, and how to avoid some common pitfalls that could that can make all the difference when you're applying for a mortgage. So whether you're a first-time home buyer, a seasoned investor, or a real estate professional, this episode is packed with valuable insights that you won't want to miss. So let's get into it. A warm welcome to you, Tim. Thank you for coming in and taking the time to talk to us on this, in what is, in my opinion, the make or break part of the home buying journey. So I'm glad you're here, and I finally pinned you down because it took me months to get you in here.
Thank you. No, thanks for having me, Joyce. I really appreciate it.
Good. I'm glad you made it. So before we dive in, let us meet you. So tell us a little bit about your background and how did you get into the mortgage industry?
So I've been in the mortgage industry this is my 25th year, actually. My background, I worked on Wall Street before I started doing this.
Oh, wow.
For about 12 years. And, right around the year 2000, I don't know if you remember the presidential election. Mm-hmm. We had no winner, right? It went on for a month. So the stock market kind of did nothing for months and months and months because they were just waiting to see what happened, to see who was going to be president. And also, and then from there, depending upon who was going to be president, what the market would do. And, I was kind of worn out from that. So I ended up selling my book. And I eventually got into mortgages, which is so much more rewarding. You're like, when you're working on Wall Street and we're doing retail, when you're making money for millionaires, they don't really appreciate it that much. But when you lose money for millionaires, they, appreciate it a lot less, Right. So there was that real reward.
Right.
I got into this business that year, actually in 2001, August, right before 9/11, which that kind of always stands out in my mind. I worked at a national company. I started as a loan officer, worked my way up to sales manager, and then branch manager for Ames Home Loan. And that branch and I'm not patting myself on the back, but we were number one for about every single month for about 3 years straight, for a company that had over 150 branches.
Wow.
Yeah. That went from about the year 2000 to about to about 2006, 2007, and you know what happened in 2008, right?
Oh yeah.
Yeah.
So
we had that mortgage meltdown, and the industry did a lot of consolidating. So I ended up leaving there, brought my team over to Continental Home Loans, where I spent like the next 18 years.
Wow.
Yeah.
But did you think in 2008, oh, what did I get myself into?
Did I think?
Or did you think I'll weather this and help everybody?
Yes, that's it. That's exactly what I thought, is that this storm would pass. And then anytime you have people, and I learned this working on Wall Street, that's why the two things go hand in hand, right. Is, when everybo's running for the hills, you run down the hills, and you want to always be ahead of the game and get away from that herd mentality. And trying to convey that to buyers, was a big part of what made me successful.
Yes.
I work a lot. I do a lot of first-time home buyers now. I do a lot of loans for veterans and a lot of loans for investors. But the most rewarding, I would say, is with the first-time home buyers, and just kind of getting back to, what I said about making money for millionaires, and they don't appreciate it. But when you take a first-time home buyer, or a young couple,
Yeah.
and you help them get into their first house, and when they get into that first house, they're on the path to generating wealth, right? They
Right,
say that
right.
the best way to build wealth is through real estate. I don't know if I'm getting off the beaten track here, but I got a great
No,
story.
go
I
ahead.
just, as far as appreciating the business, July 3rd, I just closed for a young couple. Where the buyer I met when he was 8 years old. I had the privilege of coaching him in baseball from 8U all the way up into high school.
Right, right.
And him and his fiance, we just helped them get into their house. We actually got them $30,000 down payment assistance through New York State with an interest rate in the fours. And I feel that is rewarding when you can take somebody like that you've known so long, you've had ups and downs on the baseball field, and then kind of get them into their first home. And the kid's 22 years old. You talk about generating wealth through real estate. That's really how you do it.
At 22. Unbelievable. That's an
Yep.
amazing story to
Yeah,
have him.
and it's that type of stuff that's why I love what I do now.
And you're like a proud dad,
100%. I'm like a proud dad. Yes.
That is fantastic. What does a typical day look like for a loan officer in today's market?
Well, it depends what day of the week, Joyce. So I just got off the phone with someone on my way here, that I wasn't able to get in touch with yesterday because Mondays in the summertime is absolutely crazy for us. You have your buyers out there going to open houses on the weekend, looking at houses, putting offers in on Saturday or Sunday,
Right.
getting countered on Monday. So then we have to increase the offer. We need to know what those numbers look like, and we need to get out a new pre-approval. So Mondays are kind of turning into Mondays and Tuesdays, in the summertime in this business. So that's a lot of it is we have what we call our pre-approved and lookings, right? And those people, you're kind of holding their hand all the way through till they finally get one of those offers accepted and get into contract.
Okay. And what's one thing most people misunderstand about your role in the real estate transaction?
As far as my role in the real estate transaction, I would say as far as my role, as far as the mortgage role might be a better question because
Okay.
it's so important. A big part of it is calculating income. You make a mistake there, and that's how, deals fall apart.
Fall apart and implode.
Deals fall apart and implode. And like what I like to say, we always say, like on my team is, no fumbles, right? We all work, you, myself, the attorneys, the listing agent, the buyer's agent. Everybody works too hard, to finally get
To
a
let
deal
it
into
fail?
contract in order to drop that ball. So we want to make sure we're doing all that heavy lifting up front. So what I think maybe when you say, what do people misunderstand about my role? I want to get everything done up front. So when my buyers are putting offers in on the weekend, they know that they can put their offer in with confidence because we've already done all the heavy lifting as far as qualifying with income, with assets, with credit. And I think maybe that's what people don't understand, that when one of my buyers is putting an offer in, it's as good as gold, because we've already done all the heavy lifting.
And there's a difference because, it's like, oh, I'll just finance the house. It's not just the money guy. It's the guy that's going to get you to the closing. It's the one that's going to hold your hand through the whole process.
And not only that, it's to make sure that we have the buyer in the best loan program that suits their needs, or the best loan program that they qualify for. And there's certain little things you can do as far as the qualification is concerned to make sure that buyer's getting the biggest bang for their buck, whether it's, putting more money down in your down payment, or maybe you're better served paying points to get that payment down in order to qualify. So it's a balancing act, between income and assets all the time.
Okay. So now a lot of our listeners are first-time buyers, so let's break it down. So can you walk us through the loan process from pre-approval to closing?
From pre-approval to closing. Okay. So I'm going to have my initial consultation, the first phone call. We're going to get any questions answered. I want to get an idea of where that buyer is looking, what their background is. If they're a first-time home buyer, we're going to try to get them into our program that we have through New York State, all right, which is Sony May, State of MY Mortgage Agency. But that's all about the qualification, right? Once I get the borrower's financials in, I crunch those numbers up. And what we're really trying to do in the beginning is not just qualify the buyer, but we want to establish their comfort zone. Right. So we want to make sure we kind of understand where their comfort zone is as far as monthly payment is concerned, as far as how much cash they're going to need to close that deal. So that's a big part of it. After I receive financials, I spend another maybe hour plus on the phone with those buyers to make sure that we establish their comfort zone, see what it's going to take as far as monthly payment is concerned, how much cash it's going to take them to close, and then to partner with a real estate agent who's going to help them search inside that comfort zone.
Excellent.
All right. And when we talk comfort zone, we're always talking about monthly payment. You know, what I tell my buyers is let's not focus so much on that purchase price, right, which some people do. That means that kind of tells me that they not sure what questions they should be asking if they're talking about a purchase price. Most of these buyers, they're never going to write a check for $700,000.
Right.
Right. They're going to write a lot of little checks, right? That little check is going to be part of that family, and we want to make sure that part of the family is not keeping us up at night.
Okay. And what documents should buyers have ready before they start the mortgage application process?
So if the buyer is a W-2 wage earner, police officer, a fireman, a teacher, W-2s last 2 years, 30 days of pay stubs, 2 months bank statements, all pages. We don't take screenshots. That's a big deal. That especially these days, everybody's has everything on an app.
Right,
So it's hard to get those statements out. So it's really income, assets, and credit, right? What we call in this business the 3 C's, which is credit, collateral, and capacity. And capacity being the ability to pay back, and that's kind of the biggest piece because that's where the income qualification comes in.
And if a buyer doesn't have this, they're not ready, unless this paperwork is on a pile ready to go. You can't even begin yet.
It's so funny. You go way back with me as far as the pile of paperwork.
Yep.
Everything's on the computer now. Right? We don't do that. We don't mess with bags of documents, financial documents anymore. Pretty much, especially the younger people, they can download it all and upload it right into my system. It's really made the business a lot different.
And until they can do that, in other words, it's like, well, I don't have it now, but I can get it, and maybe I'll need a date to. Okay, when you get it, that's when you are serious.
Yeah, when
Otherwise,
they submit that back to me and I can start working on it. Yes, that's
and
when
then
they're
you're
serious.
ready to go. Okay. And how important is a buyer's credit score? And what can someone do to improve their credit score before applying?
That's a great question. How important? It's pretty important. Credit score can impact not only the borrower's interest rate that they're getting, the costs associated with that interest rate, and more importantly, mortgage insurance. So if buyer's putting down less than 20% on a conventional deal, there's private mortgage insurance that goes with that. And that is very sensitive to credit score.
Do you find that the younger set, because credit is does not age discriminate. Anyone can have a bad turn on credit, whether
true.
you're young or old. But do you find that the younger set, the late 20s to early 30s, do they understand the weight of it? Do they get
I think
it?
they do. I think they do these days. Maybe not the way they did 20 years ago, but I think these days there's so many commercials out there. There's so many ways to monitor credit, whether it's Credit Karma or they go right through Equifax. So I feel like they are more aware of it than they have been in the past. Yeah.
Okay. And what is the difference, if you can explain, pre-qualification and pre-approval, and which one really matters in this market?
All right, so not a great question. Just because my answer is going to be, I don't know what a pre-qualification is. But I will tell you this. The reason I don't know what a pre-qualification is because when I started in this business, it was always pre-approval.
Okay.
And pre-approval is we are getting those documents up front. And we are crunching those numbers up front before we issue it. And when I started at Ames Home Loan, we had got not Ames Home Loan. I'm sorry, at Continental Home Loans. When I started there, we were working with guys who are like legends in this business. Mike McHugh, who was the CEO of Continental Home Loans, great guy. Really sharp as far as this business is concerned. And if you were issue a pre-approval without doing the heavy lifting up front, without doing your due diligence, and he found out, there was kind of hell to pay, because it was his company, and we did things a certain way at his company. And the whole real estate community knew that if there was a pre-approval coming out of Continental Home Loans, we had done our due diligence up front, and he created that reputation. And then it was up to the rest of us, to carry that forward, to keep that reputation going. So, that's how I learned this part of the business, and I would never really deviate. Think about it, right? Think about it. If you're just going to issue a pre-approval without checking income or credit, and there's plenty of people who do that out there. So you have to be very wary of that. But I mean, the end result is maybe you're saving a little bit of time, but ultimately you can have the buyer lose their down payment.
So the finance firm that you deal with is just as important, because if anybody can write a pre-approval, a pre-qualifying or pre-approval, and not do the due diligence, then numbers don't lie. It'll come out in the end.
Yeah, exactly.
So
garbage in, garbage out. Right,
exactly. So then it is important of who you are financing with.
Absolutely. And I'll take it a step further to go back to your pre-qualification versus pre-approval. This market's so tough for our buyers right now. We have to kind of add value anywhere we can, or strengthen offers any way we can. So one of the things I'm doing now, especially with my lower down payment buyers, is I'm submitting, if it all looks good to me, and it looks pretty clean, and I have it worked out where I know exactly how I want it to look, I'm going to submit that to underwriting, and I'm going to have a commitment within 48 hours. So when my buyers are going and putting an offer in, and the listing agent sees that it's already got a commitment from the bank, that carries a lot of weight as far as consideration that they can bring to their seller.
And you're moving this fast because sales are going that fast. And I can't even believe how far up over ask some offers go, because they just want to move. They just want to get in there.
Absolutely.
And the inventory is low at this point. It is
low. It's increasing a little bit, although it depends where. I speak in real estate offices, all over Long Island, and even in the city. And that's one question I always ask before people start asking me questions. I ask them, how is the inventory in this area looking? Are you guys seeing anything? You seeing a little bit of an increase? And I am hearing yes, a little bit more. Although in certain areas we're still going 80, 100 over ask.
Wow.
Yeah. It just.
And there's no relief yet.
And it makes it very, very tough, for our young people.
Yes, I know. And I feel bad because I feel like they're getting shut out. And it's like, it's just the time that we're in.
Yeah, absolutely.
This is what it is. Okay, so let's move on. So we have so many different types of loans: conventional, FHA, VA. It can get overwhelming for someone who's never done this before. So what are the most common types of mortgage loans people should know about, and who are they best suited for?
Okay. So you have your most common would be your conventional deals, which are Freddie, Fannie, just regular conventional deals. That'd be your most popular. I love doing VA loans. I love doing loans for veterans. There's so many nice little perks with that. You can do 100% financing with no mortgage insurance. The debt-to-income ratios are a little bit more liberal, and so is the credit's a little bit more liberal. And so the VA is it's a federal loan.
Right. Is that's any branch of the military, including
Correct.
National Guard?
Correct.
Any branch? Okay.
And then FHA is another type of federal government loan. And the FHA is changed. Back 15 years ago, my business used to be maybe 70%, 60, 70% conventional, 30, 40%, we call them government, FHA. But what they ended up doing was making the mortgage insurance permanent on FHA loans. So now we just kind of use that as a Band-Aid, where if somebody's credit is lacking, or maybe there's a spouse or another person living in the home who we can't use their income right now because of credit or because they're not on the job long enough, or maybe it's cash. So they allow compensating factors, but we're just using that loan these days as a Band-Aid. And I'm going to look to get that buyer out of that loan, refinance that into a conventional loan as soon as possible, just because FHA, they charge mortgage insurance up front, 1.75%. So
Right.
you're paying, it's almost like paying points up front. Not a lot of people know that 1.75 that gets tacked on top of your loan amount. And they also charge monthly. So you're paying both ends
Yes.
on an FHA loan.
Okay. And that is I just lost my train of thought. That there is a way to navigate through any kind of circumstance a buyer may come to you with.
Yes and no. If you have bankruptcy, those numbers, if you have a bankruptcy or foreclosure, you're going to have to wait.
Okay.
So as far as navigating, I mean, yeah, it can be 7 years, but, we could navigate for 7 years, but.
So that's the worst of the circumstance.
Correct.
But
That'd be the worst.
I would think the most circumstance of a first-time buyer is just such a newbie, just a little puppy that has nowhere to go first.
Right. And so that was the next thing I was getting into, because my team at CMG, it's the same team, from Continental Home Loans back in the day. And we do a lot of SONY May loans, probably more, than most of the banks here on Long Island.
Right.
So I've been doing them for a long time. The guidelines are pretty strict. They're pretty complicated. So you need to be, if you're going to do that type of loan, you need to work with somebody who knows it inside and out, which I do, and kind of all my team does as well. Everyone who was at Continental, we did a lot. So we all know it very, very well. There's income limits on that. And they're a little more strict on certain things as far as guidelines are concerned, like debt to income ratios are a lot lower than, say, FHA.
So as long as the buyer comes to you with every detail that falls within their realm,
You really need to do your heavy lifting on a SONY May loan. But the benefits are great. The benefits are, down payment assistance. The rate, the best rate on SONY May right now is 6 1/8. Your regular conventional rates are closer to 7. We're like 6 3/4, 6 7/8 right now. SONY May's, 5/8 to 3/4 lower.
Okay. And let's see. How do you help a buyer decide which loan type is best? Because is it what you recommend, or is it what they decide based on what you show
If they're
them?
a first-time home buyer, it's most of the time it's what I'm going to recommend. Okay. And it kind of works like this. If I can get someone into a SONY May loan, if I can get them qualified into a SONY May loan with a lower interest rate and down payment assistance, and they qualify for that, that's it. You're going to stop there.
Okay.
So that's what we're going to try to get them into. And if they qualify for that, there's not a better loan out there.
Okay. And are there any the loan programs and grants that are out there for first-time home buyers? Like, what should they know about that? First of all, that they are out there.
That they are out there. I don't love, just so you know, I don't love the independent agencies grants. They run out of money. They can take a long time.
Okay.
And a lot of times, they can go through that process, and then they have to so they get approved for the grant on that end, and then they go shopping for the house, and then sometimes by the time they find a house, that money's gone.
Oh, so not a fan.
I'm not really a fan with that. And they also do try to direct the buyers to certain banks that they do business with. So like I'm not a fan of that either.
Okay.
But I feel like so as far as Sony Mae is concerned, if I can get them into a Sony Mae loan, that's the end of the story.
Okay.
That's because it is the best loan program out there if you qualify.
Okay. And now for the first time home buyers, can you explain what points are and when it makes sense for a buyer to buy them down?
Okay, so this is kind of what I was talking to you about before. In this market right now, depending upon the loan program, I wouldn't really advise to buy points because most of these buyers, at least for the past 2-3 years, going into it, they know they're going to refinance probably within the next couple of years. All right. And this is, you've heard this saying, I hate this saying, date the rate, marry the house. Like if I hear it one more time, but that's kind of the idea behind that. And it's very important because the sooner you purchase that house, the sooner you start building equity, the
Right.
sooner you start paying the loan down, so it is important. The sooner you get into that house, the sooner you start generating wealth. If rates do come down, which they are expected to within the next couple of years, you're going to see that refinance wave. If you paid points to buy your rate down and you only had that loan for 2 years before you, even 3 years before you refinanced, you're kind of losing the money on the points that you paid.
Oh, okay. So that's how that works. Okay.
So typically, a point is 1% of the loan amount.
Yeah.
And the way we like to see it is if you pay that extra 1%, it buys the rate down about a quarter, right? Which around a $500,000, $600,000 loan, it should take about, say, between 50 and 60 months for the savings in the lower rate to pay the points off.
Okay.
So if you go ahead and do that and month 54, I'm break even. Every month after that, it's almost like a profit coming to me with the lower payment. If you went ahead and paid that and then refinanced, you lost that money. You didn't receive the benefit.
Okay.
Sometimes you have to pay it in order to qualify, but that's a different story.
And do you recommend, if you can, each month tacking on an extra 100 towards principal?
What I tell my buyers usually is I would take the principal and interest, divide it by 12, right, and add that to your monthly payment.
Oh, okay.
Right, so that's going to turn into one extra payment a year,
Yeah.
which you're going to accelerate that loan probably down. You're probably going to shave 7 years off that.
Oh, wow.
Yeah.
Look at that. Okay. Say that again. The principal and interest.
Take the principal and interest, divide it by 12, and then add that to your monthly payment each month.
There it is.
In which case, you're basically making one extra payment a year.
Wow. Excellent. Okay. So now let's talk interest rates, because everyone hears about them on the news, but actually, but what actually determines the rate that a buyer qualifies for?
So many things. The loan program, obviously. All right. And just to kind of give you an idea, one of the pros with FHA is those rates are typically lower than conventional rates,
Okay.
but you are getting hit with mortgage insurance
Oh, yes.
upfront and monthly. So you kind of always want to look at those two things. So loan to value, that goes into it. Obviously, the credit score is a big driver, and debt to income ratio.
Okay.
All of those things are going to impact your interest rate.
Okay. Can you just explain for the listener what debt to income ratio?
So most loan programs, you need to have about a 45% debt to income ratio. So to put it this way, if you made $10,000 a month and your mortgage payment was $4,500
Okay.
a month, you're at a 45 debt to income.
Okay. Got it.
I can add to that if you want,
Go ahead.
because we look at front end. You have a front end debt to income ratio and a back end debt to income ratio. The front end is the mortgage payment, principal, interest, taxes, and insurance against your gross monthly income. That's the front end. Your back end ratio is going to be your mortgage payment, principal, interest, taxes, and insurance, and mortgage insurance if there is any, plus all the debt on your credit report.
Is this as overwhelming as it sounds to a buyer, a first-time buyer? Like,
No, because it's not like I'm asking them to add it up manually themselves. Our system does the whole thing. So I kind of just walk them through it.
So they'll get a number.
I've been in this business long enough where we used to do
yes.
it by hand.
Oh, yes. Let's see. How are interest rates determined, and what does affect the interest rate that a buyer will get?
How are interest rates
Like
determined?
Does the government determine?
No. No. So what happens is mortgage rates, banks price mortgage rates off of what mortgage bonds are doing.
Okay.
All right. So the mortgage bond market opens 8:30 every morning. Just to kind of give you an idea, I'll let you know what we're doing right now.
Which is a fluctuating number?
It moves just like stocks all day long.
Okay.
Right, all day. So people want to say, I get the question all the time, what's the rate? Mm-hmm. I have people in this business 50 years asking me what the rate is.
Okay.
There's no the rate, right? The rates are like fingerprints. Everybody's a little bit different, right? Because what did we say earlier? Debt to income, credit score, loan to value, all those things impact interest rates. So there's not a rate, right? Everybody's got their own rate.
So saying what's the rate is like saying what time is it? It'll change every.
Right.
Okay. And what are some of the fees that buyers often overlook when securing a loan? Something that they said, oh, I didn't know that.
Well, I'll tell you this. I can answer that a different way.
Okay.
All right. Because I'll get asked all the time, what are your closing costs? Right? Bank closing costs, just the bank part of it, is typically at most banks, application fee, processing fee, and underwriting fee. Those are typically, your bank fees. Those are the only things that are really going to vary from bank to bank.
Okay.
Ours are about $1,500, and they've been that for, a long time. But when someone asks me, what are your closing costs? I know that they mean how much money do I need on top of my down payment to close the deal, right? So technically, your closing costs are those bank fees that I just mentioned, the appraisal fee, title bill, New York State mortgage tax, because they do such a great job up in Albany. We're one of the only states in the whole country that gets taxed on a mortgage transaction. But those add up to your closing costs. Those are going to be somewhere between $10,000 and $15,000, depending upon the price of the house. But we also have what's called prepaid items.
Okay.
All right. So prepaid items are your future taxes and insurance. You know that you have to pay a whole year of homeowners insurance up front.
Right.
You can't buy insurance after the fire, right? So we're going to have however much the homeowners insurance is, which is a whole nother, we could do a whole podcast on what insurance premiums have done over the past 2 years. Your property taxes, right? You're going to have to come up with about 8 months of those, right?
Okay.
So just if the taxes are only $12,000 a year, $8,000 there, plus homeowners being probably anywhere from $2,000 to $3,000 is going to add up your prepays to anywhere from $10,000 to $15,000.
Right. Okay.
And then you're also going to, for estimate purposes, put in 30 days of prepaid interest. So I work on referral. I've been doing this a long time, and I work strictly on referral. If I am not clear with someone, or I try to pull something over, on somebody, when somebody asks if I'm competing for a loan, and someone asks me what my closing costs are, I'm going to tell them closing costs and prepaids, and I'm going to explain it. If you deal with, say, some national company like a Rocket Mortgage or a Quicken or something, or somebody who's just not that honest,
right.
Somebody who's not working on referral, somebody who's not accountable to the person who referred the deal over, if they ask what the closing costs are, they're going to give them the technical, $10,000, $12,000.
Right.
But then when they get to the closing table, the borrower's going to need another probably $15,000.
Yeah.
So that's that. So that is when someone asks me, how much are my closing costs? I could get away with saying $1,500. I'm not lying, but it's not the answer that the person is looking for. So what I always tell my buyers is, if you're okay with the monthly payment and you can get your arms around how much cash you need to close this deal, those two things, let myself, your attorney, your real estate agent kind of worry about the rest of it. how much cash you need to close, how much is your monthly payment. If you're comfortable with those two things, your team will make the rest happen.
And of course, it's all on the closing statement anyway that they get to review.
Correct.
Before.
But when somebody is shopping for a house, they don't have that closing statement
Right,
yet, you know?
right.
So that's why, very important. I would always think, I mean, I can't imagine the biggest purchase of your life, right? The biggest investment of your life. And you're not going to work, or you're going to work with someone who's not accountable, that you don't know from Adam,
Right. And I hate those companies that you're in New York, but you're talking to a guy from the Midwest who's just
who
in a
knows
room.
nothing about Long Beach, right? And just think about all the little quirks down here in Long Beach. If you're not working with somebody local,
Yeah.
there's a lot of mistakes that can be made, and brings us
Oh,
back
yeah.
to no fumbling of the football.
Yeah, and it's funny because I buying a house, it's a milestone moment, and I'm in my own house 31 years, but I do remember it, vividly because it was such an important moment in my life, and it was like a big accomplishment.
Scary.
Yeah, but very
Little scary, little exciting, right?
Because once you get those keys at closing, it's like boom, you're a grown up. So, and it can be a roller coaster just to get there. And I can't even imagine. I don't know if I could do it now. I don't know if my
It's
brain
so
could wrap my head
That's
around
so
it.
funny that you talk like that right now, because we were just talking with friends or other people in this business. We go back to, remember that? I used to be fearless back then.
Yeah.
Now, you're right. I don't know if I could do it either right now.
And I can't imagine. I was 26.
And
you talk
fearless.
about that
And
20.
fearless.
And you had someone 22 years old
Yeah.
made their first purchase. It's like, whoa. My husband he was young. He was about 25 when he bought his first house.
Mm-hmm.
Then when we got married, this is my first house, but it was his second property. So he had already been through it before. And my husband is the type of person that he's not really into the stock market. He likes land. He thinks land is the better way. So now, after 31 years of marriage, we've bought and sold like it's nothing. Like I could do it in my sleep already. But when it's your first one, and you remember my clients that bought on Fortescue,
Yeah.
you with them. I mean, both of them, they were so excited, but you could see the fear in them. And it's like, no, it's okay. I got you. Tim's got you. It's fine. It's fine.
I mean, that, Joyce, that's probably one of the most important things,
Yeah.
about our roles in that process is, brings me back to, you're okay with the monthly payment. You're okay. You have enough cash to close the deal. You have extra money after you close, which is something we always like to see, is the borrower not go into the house with their last dime.
Right.
Have some money. We're always going to try to structure it so they have some money left over, because life happens, and we all know that.
Yes.
But that's kind of what makes our role, and people don't understand, how important our role is that we're almost like therapists sometimes, right? Don't worry, I got you. How many times do you say that?
Oh,
You
I've
know?
had plenty of clients that are on the ledge until the end, and you
Yep.
just hold their hand and say, you know what, it's okay. It's okay. And what they're feeling is perfectly normal, very much expected. And trust me when I tell you, it's okay.
Right. The anxiety is a little mixture
Yeah.
of fear and excitement.
Yeah. And I
Right.
remember I was there myself. I know exactly what they're feeling because I felt it too. So yeah, it's that never changes no matter where you are. So I feel the relief when they are done. The closing is ended. They got the keys and they're very, very happy. And I feel relieved that they got it. It's okay now. Everything is leveled off. Everybody's calm and breathing once again. So
That's one of the things I kind of I like to get into a situation with my buyers, especially the first timers, is when they're out looking for houses, if there's something that they like. So we do it a couple of different ways. Sometimes they're going to say, I'm going to see these 3 houses over the weekend. And we always want to make sure we work up the numbers on those houses before they go see them. Okay. Just so they have an idea when they look at the house, they have a feeling, I'd be comfortable here and the monthly payment's comfortable, or I wouldn't be that comfortable here and the monthly payment's going to be. So I like to get into a routine every week of working up numbers, so they can see what the monthly payment's going to look like, so they can see how much cash it's going to take them to close. And what I found is the more times we do that, if I'm working with someone for 3 to 6 months and we're working up numbers every week, they're going to have a really good feel when they go, after a while, they're going to have a really good understanding of what the expectations are going to be. They're going to be able to associate a payment with just the comfort level of being inside that house. Like, I can be inside this, I could sleep here, I could live here, I could raise my kids here, and the payment's going to be this.
Right. Right.
And I feel like the more times we go through that, they're educating themselves each time. And the more times that we do that, the more comfortable that they're going to be. And so when they put in an offer on something, they're going to put it in with conviction. And if they have to go up 10 grand and it's going to run them another $50 a month, they're okay with that too. And they'll know these things the more times we go through that exercise.
Which I think brings me to a point where for all my buyers, it's like, well, the first thing out of the gate, let's find your financial health and status here and see what you want. Because especially the young ones, they want they have the $1 million taste, but they can only afford the midline.
We run into that a lot. What happens when somebody buys their first house? What's one of the first things that they do?
What?
They have a party.
Yes.
And they invite all their friends over to check it out, right?
Okay.
And then you have people around a certain age, about the same age, going, that's what I want. They may have completely different jobs, right? Completely different financial situations, but Tommy and Janie got that house, and I want the same thing. It's almost like keeping up with the Joneses. So that's one of the things we kind of have to deprogram them from and say everybody's situation is a little different. Let's establish your comfort zone, and let's only search inside that comfort zone.
And
which is easier said than done.
How do you knock that chip off their shoulder and be polite about it when you say, listen, you think but numbers have to be on the table first.
Well, I have, we have that initial consultation, and if it's a couple, have you guys thought about, how much you'd be comfortable writing a check for every month? And when you guys think about that number and you try to come up with, sometimes I'll let them go and say, why don't you guys take a couple days and discuss that and get back to me, and then we can come back around to it. But I want you to take into account your long-term financial goals when you're thinking about that monthly number. Let's make sure that monthly, although maybe we can pay that monthly number, let's make sure that monthly number allows us to fund our retirement. Maybe college savings if you're planning on having kids, all those things. I like to vacation, I like to go away. We want to take all those things into account, and then sometimes they'll arrive at that number on their own, where I could say, okay, all right, if this is your number, this is what we can do. Sometimes that may shift the town also. Yeah. Because in certain towns, that number, if their monthly number is $4,500, and the taxes on the property are $15, or let's say $1,500 a month, because $18,000 is not crazy here on Long Island.
No, not anymore.
That, right? So if they're comfortable with $4,500, and the taxes are $18,000, that's $1,500 a month. That's $3,000 that really gets put towards the mortgage.
Yeah.
Right, a $3,000 principal and interest payment is going to fund a mortgage of about $600,000. I'm just using rough numbers off my head. Don't pull your calculator out. It's close, believe me.
Everybody, take it easy.
Yeah.
Oh God.
So sometimes that may move us out of a town.
Yeah.
Into a different town. So we're not using $1,500 of our $4,500 for taxes. Maybe we're only using $1,000 of that $4,500 for taxes, and that kind of opens up the door a little bit more.
Okay. So now let's talk about APR. What is
really?
just let the buyer know. Should buyers compare APR to interest rate? Okay.
So APR is basically what the loan is going to cost you over time. The APR is the finance charge that the bank makes, expressed as a percentage.
Okay.
So it's used to measure cost.
Okay, so cost
cost of a loan, and the cost of a loan will include mortgage insurance. So one of the things you'll see, I'll go back to the FHA loans. Those APRs are always going to be much higher than a conventional. Why? Because of the mortgage insurance. Remember, we're getting hit
Right.
up front and monthly. That gets calculated into that APR.
Okay. And that compared to the interest rate, is that a factor that should always be?
It's interest rate determines payment. APR determines cost.
Okay.
Total cost. So if you wanted to try to figure out which deal is better, APR would be one way to go on that, because
Okay.
that's going to measure your total cost.
Gotcha. Okay.
As long as you're measuring apples to apples, because you couldn't compare an FHA loan to a conventional loan using APR.
Okay.
I mean, you could, but the FHA APR is going to be much higher than the conventional.
But all that would be explained to them. So it's not like they have to guess on their own.
Oh, of course.
Yes. So, and what is something you wish every buyer understood about rate shopping? Like,
That the market is fluid.
okay. Yes.
I wish everybody would understand that the market is fluid. And if I told you a rate today, that rate could be completely different by tomorrow, and it could be different by this afternoon.
So is there, I have buyers ask me, when is the right time to buy a house? And I am of the theory that, well, the right time is when the opportunity presents. I don't really subscribe
Did you
to.
see my video that I put on Instagram the other day?
Which one?
The one about the right time to buy?
No, you tell me.
I'm only kidding.
But I don't think, oh, it's the summer, the winter, the fall. It's not. It's when the opportunity hits. So when is the best rate? Is it the here and now? Is when it applies?
Let me the best time to buy real estate, like we say in this business, we don't wait to buy real estate. We buy real estate and wait. Okay. So let's just say that, I bought today and I paid 6 3/4. My rate was 6 3/4, and I purchased a house for $600,000. And you and I were both looking to buy at the same time. And you said, you know what, I'm going to wait for rates to come down. And you waited 18 months and you were able to get a 6.5% rate compared to my 6 3/4. Who's better off?
Yes.
Who's better off, me or you? I have a higher rate, but you waited 18 months to buy in this market.
I think you are.
Yeah, I am. I have already started paying. We talking about building wealth.
Right.
I've already started paying down my loan.
Yes.
And my house has already been appreciating in this market, at least. This is the way it's been for years now.
Right.
But my house has been appreciating while you've been waiting for rates to come down.
And that brings me back to our buyers that when they closed 2 weeks later, it went up, and they did it at the exact time they should have, because they locked themselves into the best rate, the better rate.
So there's just I want to plug real quick while we're talking about it. Just at CMG, we have a float down policy that I've worked at a few different banks, being in the business as long as I have been, and this is the best float down policy that I've seen. As long I can lock a rate in. If somebody's really rate conscious, I don't like to lock right away. Because if you lock at the beginning of a transaction, you're going to have to lock that probably for 60 days, maybe more, right? The longer you lock the rate for, the more expensive it is. And if by no fault of your own, you're waiting on a seller and you have to extend that rate, you're just kind of throwing good money after bad. So I don't typically like to lock up front. I like to watch the market. I have a background in the financial markets, so I watch bonds all day long. I watch mortgage bonds. I watch treasuries. So I don't like to. I like to try to time it better, especially if I can lock. If I can get us to a clear to close and we get a closing date, and I can lock that rate for less than 30 days, it's going to be cheaper for my buyer, and they're going to benefit that way. But sometimes people are really rate conscious, and they, and I don't have a crystal ball.
Sure.
So I don't, if somebody's really adamant about it, I'll lock them today. And if that rate comes down throughout the process, as long as it comes down more than 1/4 of a point, I can float that down to them for free.
Oh,
So
fantastic.
that's another good way to kind of tackle rate anxiety.
Okay. And now we were just talking about, this is a pretty competitive market today, right now. So how can buyers stay financially smart and still make a strong offer.
Listen, I'm dealing with this every day. You know, I have buyers in all different types of situations. Low down payment buyers. Sometimes people don't. Like, I'm working with somebody right now who's going through a divorce and they need to sell their house before they can close. So we have to do it simultaneously, which isn't easy. It's not easy to get a seller to accept your offer if they know your offer is contingent upon the sale of a property, right? That makes it a little bit more difficult. So we need to use all the tools in our toolbox in order to strengthen these offers. So a couple of them would be...
now, this is trying to stay competitive without overextending themselves.
Correct, right? So what I would look to do, what I mentioned earlier, was I'll get them a commitment. That'd be one of the first things. So I know they know my buyer is as good as gold. Pretty much when we get a mortgage commitment before we have a contract, we're eliminating any pitfall or obstacle. We're doing all that heavy lifting. The only thing that could be a problem would be the appraisal or the title. And that's always going to be a problem, even if you waited. So we're going to tackle that all up front, and pretty much the only variables would be that title, that's clean, and that's not on my buyer. If the title's not clean, that's on the seller, right? So they know that's always a risk.
Right.
And then the appraisal. As far as the appraisal is concerned, I hate to see a buyer waive their appraisal contingency.
Which I never recommend.
But I'll do a range sometimes, right? So if I have like a 20% down buyer, if I have a 20% down buyer, say on a $700,000 house, we may submit that offer with our commitment, and we'll tell them we'll cover an appraisal gap of up to 5%. So this $700,000 house, if it comes in 5% short, which will bring us down to $665, we tell the listing agent we have a mortgage commitment and we will cover any appraisal shortfall down to $665. Those two things are really strengthening our offer. Now, I'll ask you a question. If your buyer had agreed upon purchase price of $700,000 and the appraisal came in at $665, how does our buyer? Do you know how do we bridge that gap? How do we tackle that shortfall? Do you know?
No.
Well, all right. So most people would say they have to come up with another $65,000. What we like to do is we will pay mortgage insurance instead.
Now, why?
Because as the bank, we're lending on the agreed upon purchase price, the contract price, or the appraised value, whichever is lower. So if I have a $700,000 purchase with 20% down, that's $140,000, right? Down payment. If the appraisal comes in at $665, my $140 on $665 is no longer 20%, right?
Right.
Right. It's 15%. So instead of coming up with $65,000, adding that to the equation, I can pay mortgage insurance probably to the tune, depending upon credit. Remember, I told you credit's very sensitive, so I always look at this up front. I have a borrower with a 750 credit score. I know my mortgage insurance is going to be really cheap, and then I can employ this strategy because the mortgage insurance for somebody with 750 credit at an 85% loan to value, it's going to be around $3,000. So instead of bridging the gap with $65,000, we can do it with $3,000. Right?
Okay.
Getting your borrower a big bang for your buck. And so many people do not know about that strategy. I don't even shouldn't even be telling it right now.
And that's something that you at CMG offer. That's not a standard practice.
I offer it at CMG. I've offered it everywhere I am. Because I understand how it works and I understand how to do it. And you're more seasoned, you're more savvy. Loan officers are going to be employing the same strategy.
Where someone else would say, all right, now you got to just come up with the money.
Right, or the realtor will say, I'm not even going to let you cover that at $65,000. If it doesn't appraise, we don't want you to go through with the purchase.
Yeah.
But a lot of times the buyer really wants the house.
Okay. And yeah. Oh man, that's a ledge moment.
Right.
that you got to talk the buyer off the ledge on that. They're like, oh my God, my dream home. Oh.
But not if we do it up front, right? Not if we do it up front. What are some of the obstacles that can happen? What are some of the issues we could run into when we're trying to buy that house? And that would be one of those things. Okay. But the original question was, how can we strengthen our offers? And I told you we're going to use all the tools in our toolbox. That's a
Right.
great one.
Okay. And let's see, how are rising or fluctuating interest rates impacting what buyers can afford? Because if you don't know, if it changes daily, then how do they know from Monday through Friday they could be in or out, depending on the rate change?
Well, that's assuming that if it changed by like $1, that they are out, right? When we're dealing with, our average purchase price here on Long Island as well, I mean, we're about 800,000 these days. So if your monthly payment's off by $100, $150, like if $100 and $150 is make or break, they probably shouldn't be buying a house at that price.
Okay.
So what I like to do when we do our numbers up front, I'll use like the 90-day moving average, which may be which would normally be a higher rate than we have today. And I always want to kind of, when we're doing our pre-approval up front and we're going through those numbers, we always want to go worst case scenario, just in case something like you said just happened.
Right. And then you got to, then they get angry. Then they get mad, saying like, "Oh, great, I can't afford
It's
this."
the market. If we have something crazy happen, like we had in say 2022, I mean, we literally had rates go from 5 to 8 in a day. Now they settled down. That's just because there was craziness going on in the bond market, and the banks are having real tough times pricing their rates out. But in that day, I mean, we saw rates go up and down with those type of swings. And again, you have to be savvy enough to know this is not normal.
Right.
Let's just take a step back, let the dust settle. And they did. Now the dust settled higher,
Yes.
in the 7s, and we kissed 8 a couple of times. But, that's one of those things where, the buyers are already anxious enough. You can't
Right.
get into that either, and that's one of the benefits, I think, of dealing with someone, what do we say, seasoned, not old, right?
Right.
So it's a
Seasoned.
seasoned,
Well
a
done.
veteran.
But I remember when it was 13%.
Yeah.
I remember those days.
Absolutely.
And they're screaming at 8. It's like, oh,
Listen, 13's okay as long as they were told 13.
yes.
You can't tell them 9 and then lock them at 13. Just like in this market, you can't tell somebody 6 and an 8th and lock them at 7. Then you're going to have someone who's pissed off. And what's our whole, every deal we try to do, right, is to get another deal,
Yes.
right? Is to make sure that person walks away with a smile, very excited, and they feel good about referring you.
Absolutely.
Because along with those parties that we talked about, what's one of the first thing is, these buyers are having a party, all their friends are coming over. They're going to get that question, who helped you? Who helped you
Absolutely.
get this? And that's where, and if we gave them a good experience, we helped them accomplish their goal, they're going to say, yeah, Joyce and Tim both helped me. And that's how we build our business, right? That's how our business grows.
That is. And what advice would you have for someone who wants to buy but is nervous about rates and the economy right now?
I mean, it goes right back to don't wait to buy real estate and wait. All right. But that's not the only advice that I would give them is let's come build a plan up front. If they're nervous about the economy, there's nothing they can really do about the economy. And every night they still need a place to put their head, at night. So, and they need a place for their family to live. But as long as we do our job correctly, right, and we establish that comfort zone, right, the economy's not going to hurt us too much.
Okay. Now let's talk red flags and what not to do. So what are some of the biggest mistakes that a buyer would make during the loan process?
Buying a car,
Yeah.
right? Any kind of real big purchase, open a new account. When you open up a new account, whether it's a credit card, installment loan, your credit's going to take a hit initially, in the short term. So besides your credit taking a hit, the other thing is you're going to mess up your debt to income ratio. So let's say I pre-qualified you and then you went and, you went car shopping after that and didn't tell me about it, right? and I have your credit report already, and I have your debt to income ratio established, and you're pre-approved, and that is typically good for 90 to 120 days, depending upon the loan program.
Right.
60 days later, you put an offer on a house, you go to contract, and I'm saying, great, it's within our comfort zone, it's within the parameters we said we were okay on. We put the whole loan into process. It goes through underwriting, and then the underwriters, they run all types of searches these days. One of the things is called a UDM, undisclosed debt monitoring, and they'll see
The police.
kind of, and they're going to say, or they're going to look in the bank statement and go, "What's this $1,000 to Ford Motor Company?" And it's going to change our debt to income ratio, and that's one case where somebody could get hurt.
Okay. So another thing not to do is not to hide anything. In other words, you have to know, and it doesn't
Dialogue,
matter.
right?
Yeah.
Dialogue. Mm-hmm.
And it's I think numbers and the truth. It's the same thing. They don't lie.
Correct.
It's just it'll come out in the end. And I just think it's just so silly because at the end it's like, what a waste of time. If this is what you're going to do, Mr. Buyer, what a waste of time.
I mean, I just had this come up on another deal that recently closed. The buyer refinanced their car
in the middle of
before.
Okay.
So think of it this way. They refinanced their car in December. I ran credit in January.
Okay. Yeah.
Right? It showed the car was paid off, but it didn't have a new account on it yet. So I did my whole pre-approval and everything, comfort zone. I got my commitment, and we were good. We go to contract in March. The buyer didn't do anything wrong. She just didn't think of it. How would she know that the new account didn't show up on her credit report, right?
Right.
And then we get the bank statements in. The underwriter goes through it and says, what is this $650 a month going to Nissan? So found out this was the new account. She paid the car off and refinanced, refinanced the car. So now there was a $650 a month liability that I had to calculate into our debt to income ratio. So
Which just changes everything.
changes everything. Luckily enough, she had the money. We paid the car loan off, and we were able to close.
But something as simple or as innocent as, hey, I'll do better for myself and refinance.
Correct.
Now just messed up.
She just nobody will put two and two together.
Yeah. Oh gosh. And have you ever had a loan fall through at the last minute so that
Just
what,
recently.
What can the listener learn from that? Like what's
In
the best
this situation, I don't know if the listener will learn anything, but I just had a big one, like $1 million, $1.2 million,
I hate those.
$1.2 million down in the West End. I hope they're not listening right now. And 4th of July weekend, the buyers live down here. We're supposed to close July 15th.
Yeah.
4th of July weekend, they're walking through it, and the house had no parking. So I think they were walking by just checking out how bad it gets on 4th of July with the no parking.
Right.
They ended up talking to one of the neighbors, and the neighbors said, oh, yeah, we haven't seen the owners since the fire. And my buyer said, what fire?
Well, yeah.
And they got into it, and it turns out that the seller did not disclose a couple of things on the property condition report.
Oh boy.
Right?
Yeah.
Or property condition disclosures.
Yes.
Yeah. And that's a brand new thing because for the last 20 something, at least as long as I've been in the business, most people just pay a waiver and not even fill it out.
Yeah,
and
no, not anymore.
what's
No.
about 6 months?
Yeah. Yeah, that's I don't know, like 11 pages. You got to
So
fill it
they're
out.
in litigation now.
Oh god.
So
Oh boy. Yeah, not the best.
that stung a little bit.
What should buyers absolutely avoid doing while their mortgage is in process? Besides buying, like I guess the car, any toy, a car, a boat,
Anything that's going to hit their credit. Opening up any accounts that's going to hit their credit. Here's another one. Don't change jobs because I've had that also.
Oh, really?
Do
Yeah.
not change jobs. Yes. So I actually had one. And I'm going back years. Go ahead.
What if it's a better opportunity and then they're going to make more money?
Well, if they're going to make more money, we still need to see at least 30 days of pay stubs from the new job.
Now it's at a halt. Now,
Correct.
Okay.
Now we have to wait for that to
Okay.
happen. I actually had one.
Which they could lose the house because the seller won't
You
wait.
could if they don't want to wait, right?
Yeah.
They could. I actually had one where the woman was a teacher, and she took a new teaching position at the end of June.
At another
So
school?
we need at another school. So we needed 30 days of pay stubs from the new school, which she wasn't starting till September 10th,
yes.
which means we had to wait into October
Oh,
to
boy.
close that deal. And this was something that went into contract in like April.
And as a listing agent, I would
Nobody-
say, oh, it's the first one to come up with the offer.
Exactly. Yep.
Oh, yeah, that's a big pill to swallow for a buyer. Oh gosh, a quick pivot. How does a buyer's financing affect the seller? So in other words, what should sellers and their agents be looking for when they get that pre-approval letter with the offer?
Okay. So I'll just bring it to this, cash is going to be their best offer,
Well, cash is king,
right?
Yeah.
So cash is king. So if the buyer, but not everybody has the cash,
Right.
right, to purchase cash. So I would say the closest deal they can get to cash, which, you want to take any of the variables out of the equation,
Okay.
right? So part of that is the big one's the appraisal, because we don't really know what it's going to appraise till after we go to contract.
Right.
Everything else we can kind of handle before we go to contract. Income, assets, credit, we're going to know all that stuff. The appraisal is like a variable.
And you had mentioned the commitment letter. If you put that commitment letter with the offer, does that knock out an offer with just the pre-approval?
I would say it trumps it, yeah.
Yeah.
For
Okay.
sure, right?
So it's important.
An underwriter's already looked at it.
Okay.
The underwriter's already approved it.
Which means that as the listing agent, I can recommend yours over theirs because the commitment letter is a much stronger, more weighted
Correct.
doc.
And think about it. It probably adds a little cash value to it too, right? Because let's just say that, you had a pre-approval with somebody 5% down, right? And you had a commitment from somebody else. If that 5% down buyer with the pre-approval wants that house, they're going to have to pay more for it,
Yes.
right? So the actual commitment could save my buyer money off their offer because it is weighted, like we said, so much more.
Okay. And then let's see. If this if the times weren't like they were, because it's a little bit nutty right now, but if the times weren't
Hopefully that part is slowing down. I'm hoping it seems to me like I can see it happening. Like we may start getting a little closer to normalcy.
okay.
And when I say normalcy, I mean prior to 2019.
Yeah.
Because I remember our last meeting in your Long Beach office, the last meeting of the year or the kickoff meeting of 2020, everybody was a little kind of disgruntled about inventory. That was kind of when it really, in 2019 was when that lack of inventory was the number one complaint, from most real estate agents.
And then as far as back as I can remember, everything had shifted. Everything changed after COVID. It just was not the same. It was like a totally
And that
different
got
animal.
to be normal, right? So
Yes,
going
that-
100,000 over was normal.
And that seems to be what it's like now. I had buyers looking at a property in Seaford. The ask was 1.250. Fantastic house, beautiful piece of property. And they wanted now, as the agent, it's like, okay, I will submit whatever number you want, but at this price point, I know it's going to go over ask. I just know it. And there was one open house on a Sunday, and we were there. And I said, okay, you really want to think about the offer? And they lowballed. And I'm thinking, this is not going to happen. It's just not going to happen. And sure enough, it went over 1.3
Wow.
from 1.250.
Wow.
And I just knew it. And it's just snatched up. And I can't even tell you about Florida. if you
Oh,
don't have
absolutely.
cash, investors snatch up everything. So, and I feel bad for these, a couple just got married. They can't afford the house because somebody snatches it up. And I think it's here. When you want the good house, like in my experience, a 750 house, 850, 950, there's room to wiggle and negotiate because you maybe have some leverage to kind of work with the seller and come up with a price that's good for both. But when it's over $1 million, it's like near perfection. So you either want it or you don't. And if you want it, you got to shut everybody out by putting a pile more
If
on
that's
the
your
table.
house.
Yes.
Yep. If that's your house.
So these are just a little bit of crazy times. But yes, hopefully it levels off. And
Hopefully, you mentioned Florida because Florida's completely turned around now,
yes, and then
where it is a full buyer's market. I do a lot of business down in Florida.
so do I.
Yeah. And I don't want to see, we could see that moving up here because there's a lot of independent things that are affecting Florida, and it's pretty funny because I did a lot of deals during the pandemic, people moving from here down to Florida.
Yeah, yeah.
And, we talked about what's going on with homeowners insurance, in HOAs. And I've spoken to a couple of them, a couple of, how's it going? And they're like, so freaking hot down here. Right? That's I'm hearing from people. They may want to come back to New York, but they may come about halfway back, halfway up there looking in North Carolina now.
Yeah. So I always try, I always try to tell the buyer, it's the end game. And when you're like 25 years old, you kind of really don't see that. But it's like, you just look at the end game. If this is your forever home, if you don't think you're ever going to move again, and this is where you want to raise your family, then it's the long term. It's not like these.
So if you're paying another 25 or another 50, and that's going to bump your payment another $100 or another $200. Yeah, I tell people all the time, you really love the house, don't lose it for $100 or $200 a month.
And is refinancing always an option?
It's not always an option. If you bought your house during the pandemic and you got a 2.75 interest rate, that is, you probably will never refinance in your life.
Okay. But for those that come in at 8,
Sure.
then
Sure.
that's always something that
But
they could look at.
I have people, just to give you an idea, last year, last year's 2024. So say in 2023, we were closing a lot of deals that started with a 7, percent. And if you remember back last September, right before the election, there was a lot of talk, was the Fed going to lower rates? Is the Fed going to lower rates? And the talk was that they were going to lower it a quarter, and then rumors started gaining steam that it was going to be a half. And I can't remember off the top of my head whether the actual cut was a half or 3/4. In retrospect now, the talk is that it was too much. But just on the news, and just to kind of give you an idea how, when I was in the stock market, we used to always, you always buy on rumor, sell on news, right? Buy on rumor of earnings coming out. And when the earnings announcement comes out, you sell it on that news and you make your profit. You have to get in early. So I kind of use that same concept to go back to my buyers and say, look, we have a Fed announcement coming up. This could have short-term impact on rates. I want to get you all queued up in my system and ready to go. So, you're going to have to move when I tell you to move. And to give you an idea, rates went down to 5.375 that day, that September Fed meeting. And I had a lot of people queued up whose rate started with a 7, and I was able to lock in at 5.375. And those who listened, and this is something I used to say with stocks all the time, my clients who listen to me do very well.
Yeah.
The ones who don't, they do okay.
And that background that you have, that gives you the edge over another.
I think so. I feel very strongly about that. And I could have you call a couple of my buyers who didn't listen.
Sorry,
you know what, my wife wants to wait. Okay, I can appreciate that. What does she want to wait for? And this is a great example of that. It was 5.375, and that was gone by the afternoon.
Amazing.
And never look back. Everybody's still waiting. And I don't know if we're going to see that for another 2 years.
And what is your company doing? What did they just get into? Something?
So CMG stands for Christopher Michael George. Right? He was just approved by the Federal Reserve to purchase a bank. So right now we're the number 6 independent mortgage banker in the country. That's different than a federal institution like a Bank of America or a Chase, right? Your CMG, Cross Country is another independent, Fairway's another independent mortgage banker.
Right.
So now we're going to be an institution.
Okay.
And what that's going to do is a lot of your independent mortgage bankers are not competitive with adjustable rates or jumbos. We look to outside investors for that type of stuff.
Right.
This is the fact when we actually close on the bank purchase is going to put us in a position to be very competitive with jumbo rates and adjustables.
Oh, so you just doubled your strength.
Exactly. And there's one other loan program that we have. I don't know how much time we have, Joyce, but this is
However long you want.
all right. Good. I could talk all day. So the CMG has a loan program
Yeah.
where we're the only bank in the country that has it. It's widely used in Europe and Australia. It's called an all-in-one, and essentially it's a 30-year HELOC with a checking account attached to it.
Now you have my attention.
Okay.
Okay.
So, I'm thinking, and this is funny. Every time I bring it up in front of a real estate agent,
I'm giddy.
the eyes light up because I think in a situation with a real estate agent who's married and whose spouse has that steady income as opposed to the commission income that we're all used to in our business, I think it works out really, really well. Think of it this way. You take out a $500,000 loan on a property. You have a checking account attached to it. Every time you deposit money into that checking account, it automatically lowers the mortgage balance dollar for dollar. And then you're getting charged interest per day on that reduced loan amount. Now, you're going to pay your bills, but we all know our bills aren't all due the same day of the month.
Right.
So the more time you can spend with that lower balance and you're getting charged interest per day, the more money that you're going to save. So think about that for somebody who's W-2'd and every 2 weeks their paycheck hits and it drops the mortgage balance. But then you have like your super spouse who comes home from their closing and drops a big check in the bank, right? Nice little check, and reduces it even more.
Now, is that something that can be offered to anybody, or you have to qualify?
Yeah, you have to qualify.
Right.
You have to qualify, and right now it's fully documented income only. All right. And look, this program is not for everybody. Right. You really have to be in tune with your finances. Usually, your higher income earners are going to use it the best. Very good for self-employed people. Very good for dual incomes.
Right.
We can also do it on investment property. So think of it this way: if an investment property is cash flow positive every month, that extra money is just going to be used to pay down. The person is going to save so much money. I just did one for a buddy of mine who purchased on Fire Island. The loan was about $900,000, 9 and change, and we compared it to a 30-year fixed. He's going to pay the loan off in 12 years.
12?
Just on the rental income that he's bringing in.
That's fantastic.
Compared to a 30-year fixed. So you familiar with the 30-year fixed amortization schedule?
Yes.
All right.
God, yes.
So did you know that amortization schedule was created 83 years ago?
Wow.
Do you know anything?
Was it by J.P. Morgan?
I'm not sure who invented it. That's a good question for ChatGPT, right?
Yeah.
But do you know anything that hasn't been updated in 83 years?
Besides the government? Wow.
There's a reason for that.
Why?
It's because the banks make so much money off of that. So everybody's big complaint on a 30-year fix is what?
Then
You don't pay anything off the first 7 to 10
Right.
years, right?
all right, I'm going to say that was a Rothschild thing.
Maybe.
Oh my goodness. So is that standard practice in Europe? That
I don't know if
program?
it's standard practice. I know it's widely used there. And that's where our, Christopher George, that's where he got the concept for. And so we could really...
Do you get pushback in the United States with that program?
No, we do not.
Okay, very good. Wow, that is good to know then.
Mm-hmm.
What a great option. My wheels are turning.
Yeah,
I
that's
got to
what
talk to Willie
it's funny.
tonight.
It's every single time I bring it up. Like if I bring it up at an open house, like
Yeah.
I'll only really bring it up at the higher end open houses,
Yeah.
you know. But the real estate agents, more than the prospective buyers that I'm talking to, the real estate agent, and I remember I had one of the agents going, I've had $25,000 sitting in my checking account for God knows how long. It's doing nothing for me, and that's it.
Yeah, I guess it's better than looking for a high interest savings account, at 4%.
Well, think of it. So you're getting charged simple interest as compared to compounded interest.
Yes. Yeah.
So it's interest per day.
Wow. Oh my God. You just blew my mind. I mean, I can't even.
All in one.
I got to find my words again. I got to look that. All right, now, I guess I got to make an appointment.
You make an appointment.
Wow. Okay. So this episode has just been jam packed with just a plethora of information. So much information. I'm so happy. So
I'm glad, Joyce.
And to wrap it up, though, what's one piece of advice you'd give to anyone thinking about buying this year? Just one, like the most significant.
I would say the best advice I could give is, you may be ready, you may not be ready. Mm-hmm. All right, let's take a look at it. If you're not ready now, let's make a plan.
Okay.
And then all you have to do is execute that plan.
Because knowing is better than guessing.
Correct.
Yeah.
How can you, in what world will we be making decisions based on guess, especially financial decisions? I like to get all the facts out in front and say, we could do this or we could do this.
Does it cost the buyer to?
It's not going to cost them anything.
No.
It's a consultation.
Right. Okay. And so.
And I love doing that as much as I love working with somebody now, because I think Joyce, in our business, we never know where our next deal is coming from.
Oh, yes. Yep.
All right. But like I always say, if we do the daily activities, it's going to come from somewhere. Right?
Yes.
And there's nothing better than getting a phone call from someone that you weren't expecting, that you spoke to 12, 15 months ago. And they said, and they give a call and say, Tim, we spoke about, 12 months ago, and you gave me a plan to pay off these debts. And if I did that, you said, and then you said my credit score would go up. You said my debt to income ratio would work. And then we took a look at it and they were right. They executed the plan and now they're a buyer. And you got a deal when you weren't looking, when you least suspected.
Sure, absolutely. Oh my goodness. All right. So is there anything else that you want to add in?
No.
Okay. I think that this was fantastic.
So do I. I had a lot of fun. Me too.
So that wraps it up for this episode of The State of Our Real Estate, your source for industry insight. So many thanks to Tim O'Hare from CMG Home Loans for breaking down the loan process and sharing some great tips for today's buyers. And if you have any questions about getting pre-approved or navigating rates or just want someone you can trust to walk you through the numbers, you can reach Tim O'Hare at CMG Home Loans in Melville or check the show notes for his contact info. And thank you to our listeners for joining us. And if you have enjoyed this episode, please tap those like and follow buttons and be sure to subscribe to our channel so that you'll be notified of our next episode. The State of Our Real Estate is recorded live on tape and is a production of Penn Street Studios, all rights reserved. Music licensed from stockmusic.com. Please be sure to come back for the next episode as we dive deep into the state of the market and discuss current trends and insights that are shaping real estate today. So until next time, please, I'm Jocelyn Costigan, and this is The State of Our Real Estate, where we keep you informed, empowered, and one step ahead. Thank you, everybody, and thank you, Tim.
Thank you, Joyce.